Las Vegas Sands Q2 2026 earnings are out, and it is a clear miss on the bottom line. Net revenue came in at $3.15 billion.
Right, which is, effectively flat, down
Right.
just 0.7% year over year.
Yeah, flat on the top, but the pain is really in the profitability metrics. Diluted EPS sat at $0.53.
Ouch.
I know, it's a 19.7% drop from the prior year. Net income actually fell 28.1% to $373 million. And, well, as you would expect, the stock took a pretty noticeable hit in after-hours trading right after the release.
But, and this is the fascinating part, right in the face of those top and bottom line drops, management immediately fired off a very aggressive forward signal to the market.
Oh, the buyback.
Exactly. The board of directors just authorized this massive new $6.0 billion stock repurchase program extending through July 2029.
Which really feels like a massive counterpunch from the C-suite.
It absolutely is.
It's basically their way of staring down a rough quarter on paper and telling the market, hey, we think this underlying business is incredibly undervalued right now.
Yeah, and that aggressive posture really sets our mission for this deep dive. Because for you, the retail investor trying to make sense of all this, we really need to look past that top-level earnings miss.
Right.
Consolidated adjusted property EBITDA, which is, their core measure of operating cash flow, that fell 16.1% to $1.12 billion. So we are going to unpack exactly what happened in their two distinct operating environments.
That's Macau and Singapore.
Exactly. We need to analyze the severe margin compression they are dealing with, break down the critical impact of casino hold versus actual gaming volume, and ultimately evaluate the risks behind their heavily leveraged balance sheet.
Especially paired with that aggressive buyback strategy.
Okay.
So let's start with the core paradox of this quarter, because this is where it gets really interesting to me.
It's a weird one, for sure.
Right. Imagine getting dramatically more high rollers through your casino doors. You're watching them wager billions of dollars more than last year, and somehow your net income still plummets by 28%.
It defies logic at first glance.
It does. So to understand how a basically flat top-line revenue resulted in that kind of plunge, we have to look directly at the performance of Sands China in Macau. That is where profitability took the absolute hardest hit.
Yeah, the segment details coming out of Macau are just jarring. Sands China net income plummeted 50% down to $107 million.
Wow. Cut in half.
Literally cut in half. Macau adjusted property EBITDA dropped 24% to $430 million. And the EBITDA margin suffered this just severe compression, falling 750 basis points to just 24.0%.
Let's just pause on that for a second.
Yeah.
Losing 750 basis points. I mean, that is a massive 7.5% chunk of their profit margin just wiped out in a single quarter.
It is a brutal hit to efficiency. And the primary culprit here is what the gaming industry calls the hold factor.
A house advantage, essentially.
Well, the actual realization of it, yeah. Specifically, they saw an unusually low hold percentage on a rolling play, which is the high-stakes VIP segment. In Q2, the rolling win percentage fell a staggering 221 basis points to just 1.35%.
Okay, let's translate that math for everyone. The casino essentially expected a 3.3% hold on that VIP play.
Right, the statistical average.
Meaning, for every $100 wagered at the baccarat tables by these whales, the house expects to keep about $3.30 over time. But this quarter, they only kept $1.35.
Which is a massive statistical swing in the wrong direction. That bad variance directly cost the company $87 million in adjusted property EBITDA for the quarter. Just vanished.
Okay, I have to jump in here, though, and push back a bit on the inherently negative framing of this earnings miss.
Go for it.
Because if you look past the bad luck and look at the underlying behavior of the customers, the volume's still a completely different story.
They do. The volume was huge.
Right. Rolling table volume, the total amount of money actually put on the felt by VIPs, skyrocketed 73% year over year to $7.6 billion.
Yeah, the sheer surge in capital flowing through the property is undeniable.
So, trying to put this in perspective, it feels like a casino running a wildly successful marketing campaign. They got way more whales through the front door, they put them up in the penthouses, got them to the tables.
But those whales just happened to run incredibly hot at the cards this quarter.
Exactly. Plus, non-rolling volume, the regular floor play, that was up 15%, and slot volume was up 30%.
The floor is packed.
Right. So I have to ask, isn't a 73% surge in VIP volume and double-digit bumps across the rest of the floor a massive fundamental win? Doesn't that make this EBITDA miss just a temporary statistical blip? I mean, The house always wins eventually.
Well, that is the exact thesis management is defending. And honestly, the broader market mechanics actually back up your point.
How so?
Because Sands China didn't just increase the raw volume of cash moving through the building, they actually grew their mass market gross gaming revenue market share by 100 basis points to 25.0%.
Grabbing a full quarter of the entire Macau mass market. That's wild.
It is, which is a phenomenal operational achievement, completely regardless of the wild variance happening at the VIP tables.
Because the mass market is generally where the margins are stickier,
Right.
right? I mean, it's much less volatile than a few billionaires running hot and skewing the quarterly math.
Oh, absolutely. The law of large numbers smooths out the mass market. Thousands of people betting $50 is always more predictable than 10 people betting $500,000.
Makes total sense.
But there is a deeper context to these volume surges that we really need to look at. It's about how capital investments in premium offerings are fundamentally shifting the internal property dynamics in Macau. We are seeing a passing of the torch within the Sands portfolio itself.
You're talking about the Londoner.
Yes. Let's look at the numbers. The Londoner Macau generated $710 million in revenue this quarter. It actually outperformed the historical crown jewel of the company, the Venetian Macau, which brought in $591 million.
And the Londoner is the property where they've been pouring hundreds of millions into premium suites and like high-end hospitality upgrades since 2020. They basically overhauled the entire footprint to cater to a much wealthier demographic.
And this quarter proves that the thesis works. The Macau market growth right now is heavily skewed toward that premium segment.
It's not just a gambling trip anymore.
Exactly. It's not just about throwing dice. These customers demand world-class culinary experiences, ultra-luxury suites, private gaming salons. It is deeply competitive.
So they have to spend to win them over.
Right, and the properties where Sands has introduced these refreshed premium spaces are generating significantly stronger performance than the legacy parts of the portfolio.
Which explains the divergence between the properties, then.
Yes. The Venetian, which hasn't seen the same level of recent high-end overhauls, actually saw its adjusted property EBITDA drop over 30%. Meanwhile, the Londoner's revenue grew over 10%.
Oh, wow.
Management is literally having to shift the center of gravity in their own portfolio just to meet the evolving expectations of the new Macau consumer.
All right, so if Macau's profit drop was basically a story of great volume ruined by terrible luck at the VIP tables, we really need to look at Marina Bay Sands in Singapore to see if the core business model is holding up.
Yeah, Singapore's a totally different story.
Because the twist here is fascinating. Marina Bay Sands actually had favorable luck this quarter, yet they still posted declining profits.
It is the exact mirror image of Macau in terms of statistical variance, but somehow, yeah, it ends up with the same bottom line trend. Marina Bay Sands adjusted property EBITDA decreased 10.3% to $689 million.
And similar to Macau, margins compressed.
Right. They dropped 540 basis points to 49.9%.
I mean, nearly a 50% margin is still incredibly high compared to Macau's 24%, but losing 540 basis points in a single quarter is a painful squeeze, especially when you consider the variance you just mentioned. The casino's hold was actually in their favor here.
Right. Contrary to the bloodbath at the VIP tables in Macau, Marina Bay Sands experienced a higher-than-expected hold on rolling play. The house ran hot.
And that matters for the bottom line.
Oh, hugely. That good luck actually boosted EBITDA by $37 million for the quarter.
And we know this data isn't just an estimate anymore, right?
Yeah, we know it with extreme precision. Marina Bay Sands has fully implemented new smart table technology across the floor.
Let's unpack how that actually works for the listener, because it fundamentally changes how a casino operates.
Yeah.
It's not just a pit boss eyeballing a tray of chips and guessing anymore.
Far from it. These smart tables use RFID technology embedded directly into the chips, and that's combined with overhead cameras and software.
So it's tracking everything.
Everything. The table tracks exactly what is being wagered, by whom, on every single hand, in real time. It completely removes human error from the equation.
That is incredible.
It allows the casino to calculate a highly accurate theoretical hold, meaning exactly what they should have won, based on the pure math of the games. And this quarter, that theoretical hold was 4.2%.
And they actually held above that 4.2%. They won more than the perfect math said they should have. Okay, so this presents a glaring contradiction that we need to figure out.
Lay it out.
Mass win in Singapore was up 5% to $886 million. The smart tables confirmed the casino held above expectation on the VIP tables, adding a $37 million surprise to the good.
Yeah, the revenue levers were definitely pulling in the right direction.
So it's like getting a massive year-end bonus at work, but then realizing your cost of living went up so drastically that your bank account is somehow lower than it was last year.
That's a great way to put it.
If they ran above expectation in Singapore and mass volume was up, what on earth is eating almost 550 basis points out of their operating margin?
Well, it comes down to the brutal realities of competing for that premium customer we were just talking about in Macau. While mass gaming grew, the rolling win, despite the good luck on the whole percentage, actually decreased 7% to $439 million overall.
Why? Because the total volume of VIP money wagered was lower?
Exactly. They want a higher percentage, but of a significantly smaller pie.
Ah, I see.
And defending that pie is the most expensive part of their business model right now. To maintain their market position in a deeply competitive Asian premium segment, management is locked into continually reinvesting in the customer experience.
Right, the Michelin star meals and all that.
Yeah, building out industry-leading suites, providing the comps, private aviation, high-end personalized service. None of that comes cheap. It inherently inflates operating expenses.
So the cost of keeping the whales happy, and frankly, keeping them away from competing resorts, is actively suppressing the EBITDA margin. Even when the casino is winning on the floor, the background costs are bleeding the bottom line.
Yeah, that is the core tension of the integrated resort model in Asia today. You are essentially locked in an arms race of luxury.
An arms race. Yeah, that's exactly what it looks like.
You have to spend aggressively on operating expenses and capital expenditures just to maintain your current market share, let alone grow it. That margin squeeze at Marina Bay Sands is simply the cost of doing business at the absolute top tier of the market. You just can't offer a B-plus experience to an A-plus customer and expect them to return.
That sets up a really interesting dynamic for how management is handling the company's cash.
For sure.
With both major segments suffering from margin compression and dropping EBITDA, you have to look at how they are allocating capital in response. Because, human nature, or at least conservative corporate nature, would be to hoard cash to weather the margin squeeze and fund that luxury arms race.
Right. Keep the powder dry.
But instead, they're returning capital to shareholders at a historic rate. Let's look at the balance sheet.
The capital return specifics are just staggering, especially given the earnings miss. Las Vegas Sands repurchased $787 million of common stock just in Q2 alone. That was 15.03 million shares at a weighted average of $52.37.
And if you zoom out to look at the longer trend, since they reinstated the buyback program in the fourth quarter of 2023, they have repurchased 16.3% of all outstanding shares.
It's a massive reduction.
They have returned over $6 billion to shareholders in less than 3 years. Plus, they are still paying $1.30 per share quarterly dividend.
They are aggressively shrinking the float. Every share they buy back makes the remaining shares represent a larger piece of the company's future earnings, and they have the liquidity to execute this, partly because they finally closed a major chapter in the company's history.
Right, the Vegas sale.
Exactly. They fully exited the U.S. market financially this quarter. In May, they received $1.26 billion from the final seller financing payoff for the Las Vegas property sale.
So the name is Las Vegas Sands, but they are a pure-play Asia company now.
Entirely. And when analyzing their ability to fund these buybacks, you really cannot overlook the underlying strength of their Asian retail malls.
Oh, the non-gaming assets.
Right. These non-gaming assets act as a massive cash flow buffer against the volatility of the casino floor. The Venetian Macau, for example, is generating an astounding $2,161 in tenant sales per square foot.
Wait, $2,161 a square foot. That is an astronomical number for retail real estate. That puts them in the absolute upper echelon of luxury malls globally.
It really does. It's incredibly lucrative.
But this brings up the ultimate risk profile question for you, the retail investor holding the stock. Because the buybacks sound great, the dividends provide income, the retail malls are printing cash. But look at the debt load.
Yeah, the debt is significant.
Las Vegas Sands is sitting on $15.11 billion in debt against just $3.38 billion in cash. That is a net debt of $11.74 billion, which represents a net leverage of 2.2x.
A highly leveraged balance sheet is a reality of the casino business, but there is no denying those are massive absolute numbers.
I'm trying to wrap my head around the strategy here. It almost feels like they're treating their balance sheet like a gambler using the martingale betting strategy.
The double down strategy.
Where you lose a hand, so you just double your bet on the next one to try to make it back. They are paying out heavy dividends. They just authorized another $6 billion buyback, effectively committing to buy back another sixth of the company, all while sitting on $15 billion in debt.
It sounds aggressive when you put it that way.
Right. If there is a sudden macro downturn in the Chinese economy or, a disruption in Asian travel, does this aggressive capital return program suddenly backfire and leave them dangerously overleveraged?
I see the comparison, I really do. But management would argue they aren't blindly doubling down at a roulette table. They are investing in a house edge they understand perfectly.
Okay, lay out the bull case on the debt.
To balance your concern about the risk, you have to look at the incredible cash generation engine of the integrated resort model when it is operating at scale. Yes, the gross debt is $15 billion. But Las Vegas Sands generated $3.73 billion in trailing 12-month operating cash flow.
That is a lot of cash coming in the door.
And they have $7.64 billion in total liquidity when you factor in their revolving credit facilities.
So from management's perspective, the debt is easily serviced by the sheer volume of cash the properties throw off every single month.
Right. The cash flow covers the debt obligations with plenty of room to spare. By executing these buybacks and dividends, management is essentially signaling supreme confidence in the durability of their model.
Betting on themselves.
Exactly. They are telling the market that their upcoming capital expenditures, like the $332 million they spent this quarter alone, largely on the Marina Bay Sands expansion, will generate returns that far out-earn the interest cost of their debt.
So they aren't worried.
Not at all. They firmly believe their equity is undervalued at current prices, their cash flow is highly durable, and their aggressive reinvestment in premium properties will defend their market share against any potential macro headwinds.
It really forces you to chew on the unique dichotomy of investing in the gaming industry. It's unlike almost any other sector.
It really is unique.
A company can execute its strategic vision perfectly. They can increase their VIP gaming volume by 73% year over year. They can successfully build out world-class premium suites at the Londoner to capture the new luxury demographic.
They can do everything right.
Yeah. They can optimize their smart tables in Singapore to track every single chip, generate nearly $4 billion in operating cash flow, and still watch their quarterly net income get cut in half simply because the dice didn't roll their way over a 90-day period.
The short-term variance is entirely inescapable. You can optimize the math all you want, but you can't control the immediate outcome of the cards.
Which leaves you with a critical question to explore on your own. As a retail investor looking at this stock, are you buying into a long-term cash-generating hospitality and real estate business? Or are you essentially just fading the variance of the gamblers on the casino floor, hoping the house runs hot next quarter?
Make sure you follow the show for daily earnings coverage.